Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as I go through it with you guys, generally related to three different topics: wealth building, commodities, and/or financial topics. Let's dive in, take a look, see what people are sharing. If you want to follow me, it's at Finance. And if you want to join our community, finding-value.com. I dive deeper into all this topics and subjects, looking for potential investment opportunities and sharing those opportunities with everyone in the community. I also talk about how I set up my portfolio. You can see that portfolio allocation, different strategies. I dive into what I do, and you guys can either follow along or use it in your own strategies and approaches. We do have a special coupon code special that is active right now if you like to join up. And it is 50% off the first month and a larger discount for the yearly membership. And anyone on a monthly membership can go to a yearly membership and get those savings if you'd like. So, uranium trends, it says just check the most recent Bannerman investor presentation. This is not exactly the case of a looming uranium shortage in the midterm horizon. It says persistent cumulative supply gap of approximately 150 million pounds. And then it shows in here in the mid 2020s, 25, 26, 27, 28, 29, there's not a huge gap there. And I can't tell you what the uranium inventory level is. I don't know how to look at it. I don't think anyone knows exactly what people have for inventory levels around the world. It's like a hidden secret. But I'll tell you this, guys. There's a couple of things that I look at that I think are incredibly positive, and we're going to go through it together here. In 1970s, nuclear was taken off quite big. Did you know there was a major surplus of uranium inventory during that time frame, and the uranium price went up massively? Did you know that there wasn't a gigantic supply deficit in 2000 to 2007 when uranium ran? It was a commodity bull market that pushes these things forward. The supply demand gap out in the future is definitely a huge problem, but it doesn't mean that we have to have this gigantic gap occur immediately and have the price and the price not go up. The commodity bull market's a big deal, and the decline of dollars, the value of the dollar, is also a very big deal. And I want to show you something on URA. I put this on here. Oops, I was supposed to be typing in when it's in here. So this is URA. All right, this is the uranium ETF global URA. We can put it on candles here. I want to show you a couple of things, guys, because I think everyone needs it. I'm looking at Twitter. People are getting frustrated, annoyed. They're selling. I'm not saying that you shouldn't sell for whatever your situation is. I'm just telling you that I think that we have a very bullish setup. This is the setup, in my opinion. We've got a double bottom. I grabbed this from Stan Weinstein's book. And this is your bottoms that I'm seeing all over the place in all of the different commodities. This one here in particular is URA Global X Uranium ETF. You get this double bottom, and this bottom sometimes pulls back and slingshots up and out, or it's roughly the same height, and sometimes they don't pull back as much. It's still a double bottom. A is the breakout, B is the backtest. Do you see any sort of similarities between this double bottom and what I have down here? In stage analysis, this is stage 4 decline, stage 1 bottom, and stage 2 advance. And we are literally staring at what would be the most ideal entry point according to the book, which is B, the breakout and B of right here is your ideal entry point. And we're just above that ideal entry point, working our way on up. And everyone is too impatient to make money on this. I purchased on the breakout here in October, November of this retest is where I purchased over here in my favorite companies. I did very well. You can see those companies even on the YouTube channel that I've got you're listening to. And we've got all these setups that are occurring in the markets here that look exactly like this. And what I call that is a confluence of information. A confluence of information is information that all stacks up to say something. We also have a bunch of other information that are all aligning for a commodity bull market to occur. All of it is in alignment. So don't get too frustrated. And I'll read through some of this. I'm going to read through the frustrations. Uranium investors are nervous. UI newsletters at a 40% discount. Angry comments all around. Sachem Cove significantly trimming holdings as per 13F redemptions. Rumors of other large funds selling. Calculated valuations at current terms yesterday. Some start to look cheap again. I'm going to show you something, guys. And this is some of the stuff that I go over on the website. Here is your longer term market cycle. It is a fractal. A fractal is a pattern that repeats over time on different time frames, and it repeats over, and over. Now, sometimes this is your double bottom down here a lot of the times. Sometimes it rips upward like this, so it comes up and then consolidates above. Sometimes you get a bottom that looks like this and it pulls back and then goes on up. This is kind of what a lot of the gold companies are doing that are down here. Right now, if you were to ask me where are we located on this chart, I would say it's in disbelief. It's in disbelief. This is what's coming after disbelief here. You get this little pullback. Generally, it's on the top of this, and then we rip all the way up. This is what's coming. But everyone's in disbelief. They're selling. This rally will fail like the others. This is all market psychology. It's all psychology. Other areas of the market, like in technology, I think will eventually get out of euphoria, thrill and euphoria up here, and then we'll get a bull trap. We are going to set a bear trap for commodities. The bull trap will be set here in these stocks. So we could get a pullback, whatever it looks like. We could get a pullback here in URA where maybe we dip and before going higher. That's not going to scare me out of it. Now, how long could this go up? I'll be honest, guys, I think it could go up a very long way and a very long time. I think we could go up for 30 years even. Why? Because if we hit problems in oil, which I think we will, we are going to spark a gigantic move in nuclear. So I view this as one heck of an opportunity to buy something at just off a stage 1 bottom, which is just entering stage 2. I mean, guys, you're crazy to be looking at this on a short-term basis. If you're zoomed in like this and you're just seeing these markets move all over like that, you're going to go crazy. I think you need a big long-term perspective. This is a whole very nice entry point for a long-term investment. Gold's our leader. What is gold doing? It's ripping like it's never ripped before. Rippity rip all the way up. There is gold. I can put it on here. We can do XAU USD, which has a little bit more data back here. I'm gonna make something very obvious here. Commodity bull market. Commodity bull market. Commodity bull market. Commodity bull market. And that started in 2018 when it started to go up in 2019. So 2020 was our bottom in the majority of commodities because commodities are delayed behind gold. Gold is our leader. It is ripping to the upside. What makes you think we're not going to go into a commodity bull market when gold's doing this? Central banks are not buying gold because it's going higher. They're buying gold because bond prices are broken. Here's your topping pattern in bonds. It's broken the uptrend line. We can see the downtrend line in yields, which is the inverse of bond prices. There's your mix. You've broken the downtrend and it's in an upward move. Now here's the thing, guys. We could very well have a pullback that scares everyone out, and then we rip, and commodities just do absolute gangbuster stuff here. I'm not sure if we'll get the pullback or not. I just don't know what it looks like. But sometimes these breakouts, if they're real big like this, we can get a pullback before going higher. That's the big picture view. The central banks and people around the world, and this is going to take time because this is what they understand. They understand this decline in interest rates. They think that money is going to continue to pile into intangible assets. The game has changed. It's broken the downtrend. The game has changed when we look at the bottoming patterns that we're getting in these asset classes. Stage 1 bottom. We can go look at other asset classes. Double bottom, stage 1 bottom. Breakout, ideal entry point, A, B, all interconnected. This is copper ETF, just to show you guys. We can even look at other things like Canadian crude. There's your bottom one. There's your slingshot phase where you slingshot it all the way up out of the pattern. Then you do a consolidation, A and B, and you should be consolidating oil in this general area here. I'm going to keep diving into this. What happens after Nixon revalued U.S. Treasury gold from $35 to $44 an ounce on May of 72? This is what occurred. The biggest bull market in gold in history. It did a 25x from 1970 all the way to 1980. 458% rise. Could something like that occur again? Yeah, it could. During this time frame, there were other things on larger market cycles that were also occurring that we have today. Just to say that, and I say that for some of the members of the website there. Gold revaluation in 1973. There's a key critical point here that I want everyone to understand. So the last time we revalued gold and did not reduce debt with it was February 1973. This happened most concurrent with the oil crisis and facilitated the first major inflation spike, 12% in 1974. The driver of this, guys, is the oil crisis. Oil crisis and interest rates are interconnected. Let me show you something. Let's go back to US oil, WTI crude oil. Take a big picture view, back out, so we gain a longer term perspective here. This here is a fractal. Let me describe this first. You get a consolidation, 3-hump consolidation, 3-hump consolidation, 3-hump consolidation. That is when we overproduced oil and oil consolidated sideways for a large period of time. It's the out of cycle phase. Your in cycle phase are the advancements of the upward moves of oil. Notice the similarities of each of these cycles. They're all the stinking same. Then I took the fractal. Here's the fractal. A fractal is a repeating pattern that occurs over time, and I stretched it just a little bit to overlay it on top of this one. And I think we're going to go up to the upper end, and the upper end of this is around $600 a barrel. And I know that seems very difficult to understand right now. I don't expect everyone to believe it or understand it. They will after it occurs. That is what I think is coming, and I think that these waves that we get, wave 1, wave 2, wave 3, wave 4, wave 5, wave 1, wave 1, wave 2, wave 3, wave 4, wave 5, wave 1, wave 2, wave 3, wave 4, wave 5. There we are. That is what it's going to look like. I know that's a lot of stuff being drawn on there. Now, what else can I use to basically use as evidence that this is going to occur and play out the way that I think it's going to play out? If oil is going to do this, and we've got gold and all those other things going up like that, this is silver. Say hello to Citadel. Look at this thing. What is that called? A cup and a handle pattern. It's broken to the upside, and it's starting to run to the upside. I think that this is going to have a major move. This here is interconnected to oil that I just showed, which is interconnected to gold being our leader, which is interconnected to URA putting in a bottoming chart and pattern of stage 1 base. They are all interconnected. The US 10-year yield is interconnected to oil breaking out. And this is one of the reasons that we're breaking this downtrend to the upside. Now, could there be a short-term recession or slowdown? That very well could happen, but it doesn't change the move. See the patterns. It's all these waves, and here's the waves coming up here as we go up. Moves in waves. Coming back. All SAGD projects are very economic, including payment of royalties, taxes, and enjoying a 10% rate of return. Rick Warner's retired executive talking about some of the projects in oil. You know what? I've got my favorites of SAGD producers, what I'll say, and I share those with you guys on the website. Here's Philip. He says, we're on the depletion curve that I don't know, or that I don't think many customers have realized, says Corey Kaz, Vice President of Investor Relations at Cameco. Guys, it's all laid out in front of you. You can take advantage of all this. You just have to be patient. Patience is what kills people in these investments. You have to buy them and sit in them and just wait. Here's Josh. He says, people don't own enough physical gold and silver for what is coming this decade. He's exactly right. How does he know? How do I know he's right? Because of this. The breakout of the 10-year yield, because of the breakout of the cup and handle here. And gold's front running it all because of the silver pattern of the biggest cup and handle of everyone's life here. And it's already broken out and running. You don't own enough. Well, I do, but I don't know about others. The biggest contributor to loneliness, depression, and declining birth rates is social media. And these are people, daily average time with friends in minutes, down, down, down. Everybody's sectioned off and siloed. And I know this is a financial channel, but just be careful here, guys. Get your FaceTime. Short interest in China is now at an all-time high. Here's short interest record high. Let's go check something out on China here. Here's China. What is this? It's a double bottom. We've broken the double bottom. Your ideal entry point was here, and now we are breaking to the upside. This whole thing, I think, is a false breakdown. You know what's going to drive this? Currency exchange rate. Here's your 3-hump consolidation that we just saw in oil and everything else in this world. This is your false breakdown when they lower or they raised interest rates, the dollar went ballistic, and everything fell during this time frame. This is going to be a slingshot to the upside, I think, and it's going to squeeze the short interest here. That's what's going to be a driver. Now, I'm not putting everything I own in one or two or three different ideas. I've got like 6 or 7 different ideas here that we could play that look pretty good. And I have my favorites in China, which look good. In gold we trust, our projected gold price for 2030 is $4,821. So like it if you think this is too high, and repost if you think it's too low. I think it's too low. I think we're going between 8,000 and 15,000 or more. So I'm between 8 and 15. Here's the thing about short sellers that I think gets forgotten. Short sellers are guaranteed future buyers. Longs are only promising to be future sellers. Interesting that the large cap China ETF has never had this many short sellers who have to buy. Physical gold stress, so refineries imposing surcharges and suspending production. Metalor, one of the leading Swiss refineries, has recently introduced a per ounce surcharge on all of its gold products due to shortages. Another major Swiss refinery, Arger Heraeus, has suspended orders. What's going on here? This is one of the reasons that I don't wait around. I buy stuff when things are cheap, and I just buy it when I've got the max ability to buy this and low premiums. I, I don't know. Maybe there's a problem in physical silver and gold that we could potentially go up against. And I'm sure if gold has a problem, it's going to cause panic in all of the metals. So then it's going to squeeze everything. Uh, Everything being platinum, palladium, silver, and gold, the precious metals. Here's North Star's capital rotation event chart. It's Microsoft breaking down versus gold is not something you should ignore. You can benefit enormously from it. And again, this is back in 99, 2000. Here we're breaking down and a massive gold bull market tech collapse coming. I think so. And this is the beginning of the bull market. If you had purchased a bunch of uranium stocks back in 2000, 2001, and you had to wait a little bit, you might have been early on some. But they took off later in this bull market. It's coming, guys. It's right in front of us. I mean, I don't know what else has to slap you in the face and just say, look, it's right here, dude. It's right here. That's one chart. Now, other ones are in progress, so it's going to take a little bit of time. Patience. Bramer says, we believe sanctions on tankers used to move Iranian oil are likely to increase under Trump's policy of maximum pressure. This would boost demand for compliant VLCCs. Just keep in mind, guys, that we're in a bull market. One of the things that they say in the book, Jesse Livermore book, Reminiscences of a Trading Operator, Mr. Partridge would always say, we're in a bull market. We're in a bull market. We're in a bull market. It's probably because we're in a bull market. That's what we're in commodities. We're in a bull market. It's just starting. We're in the bull market. You don't want to sell. All of the big moves the big money is made in the big moves. The big moves are that you can capture is all about sizing it up, sizing up appropriately. So when I look and I size this thing up, it says commodities will return. It's all about sizing this up. And we're coming from very low levels of this ratio where everyone's piled into the S&P 500 in the declining interest rate environment that has broken out. It's going to change and it's going to come back up. There's other things that I look at, indicators that would tell me that these were potential tops. I'm not going to share those indicators. I do that on the website, but there's other things behind the scenes where you can use other indicators here of a potential turn. But we're at a very low level, and as Mr. Partridge would say, we're in a bull market. Don't mess it up. Grady said 2 years ago this red parabola was in play, still following the uptrend line perfectly. The red parabola does make perfect sense time-wise and price-wise. And there we are breaking higher. Gold leads the bull market. Everybody wants a 10-bagger. Nobody wants to hold when the stock drops 50%. I would say the majority of my stocks have dropped 50% at some point when I hold them. And some of them are still up well over 20 bags, 10 and 20 baggers, still even after dropping off their all-time highs. The reason I'm not selling is because I don't want to pay taxes on the ones that are in taxable accounts. And I think we have a long way to go. I think we are coming out of these bottoms. So I 10 bagged or 20 bagged off the bottom of 2020 on some other companies. Not some, I have quite a few. Now, I didn't, my success rate's not 100%. It's more like 50 or 60% or something like that. So when you think about strategy here, guys, if you're playing the long term, you're shooting for 10 bagger pluses. And as long as the market conditions are good, I'm going to continue to hold. As long as I think the market conditions and the ratios are cheap, look good. So I'm going to have to ride through some 50, 60% pullbacks. It's part of the game. So everybody wants that 10 bagger, but they're not willing to put up with a 50% decline. In order to make the most of this, I'm riding through it. And you guys, I mean, obviously you can learn from me if you want on the website there and see what I'm doing. Because I share my buys, I share the reasoning, and you know, I'm gonna dive deeper into the companies like we did last Q&A, and we're gonna go even deeper. I'm gonna go off the fundamental side of things, and we'll look at both commodities and also non-commodity stocks. I can show you guys what I mean and what I look at least. But not many people. Everybody wants it, but they're not willing to get there. They're not willing to survive these pullbacks. These are going to be frequent. Ramit says the single most important factor to getting rich is getting started, not being the smartest person in the room. And Charlie Munger says opportunity doesn't come often, so seize it when it comes. You need to be able to figure out what opportunity looks like. I will go through next Q&A session what opportunity looks like. I will go through the fundamentals, I will go through the technicals and show you what it looks like. And then what hopefully you can do is replicate it. The problem is it's difficult to replicate because when I was buying at the bottom of some of these things, people are so negative. And if you're doing something that's opposite of everyone else, you better damn well know what you're doing because they're going to tell you a bunch of crap and the news is all garbage. They're going to tell you, oh, it's not good. Oh, oil's going away. What's her name? The one that runs Kathy Wood. She was saying, oh, oil's extinct. It's going to go away like whale oil or something. And I'm like, okay, sure. And it went straight to $150 a barrel, or no, $120 a barrel from that negative move in April of 2020. And now we're gonna go way higher, way higher. Well, how come there's other people there's going to be a lot of people who disagree with what I say. And you know what? I don't care. I think I know the market better than most anyone that I've seen. And that's what gives me the conviction. And I have to have that conviction in order to hold on. I have to believe that. And maybe there are some things that I can still polish up for sure. But I have to have at least that conviction to hold on through these big pullbacks. Here's Logan, and this is part of the cycle too. It says, remember one thing, active inventory is all that matters. NAR data historically has been between 2.5 million. In 07, it was 4 million, and today we are at 1.15 million. We are not in a bubble. That's not what a bubble looks like. It's not what it feels like. It's not what it tastes like. The real estate bubble boys are wrong. Now, that doesn't mean that we can't get slowdowns in price appreciation and sales, but you can't be in a bubble when there's a shortage of inventory. It's not congruent. Now, what happened last time is we gave out a whole bunch of loans to a whole bunch of people that were not qualified. Foreclosures and new bankruptcies are still below pre-pandemic levels. Not this time. This is last time. Not this time. You're still incredibly low for foreclosures and bankruptcies. So I hate to say it, but the bubble boys, we need to pop them. They're wrong. Majority of investing mistakes come from trying to cram long-term returns into shorter periods of time. Just be more patient. It's not more complicated than that, says Morgan Housel. And that's where I'm going to end it. Just be more patient. So that's what we've got today. Give me a thumb up for the content. Subscribe to the website if you like. Specials coupon code if you like to use that. And if you want to join the yearly membership, you get a bigger discount. We went over last Q&A session just to give you guys an example. Last Q&A session, we went over kind of the technicals of how I approach companies and how I find them, some of the patterns that repeat over time, and showing those patterns in the same fractals and the setups that we've got today. So I went over a lot of what I would consider to be very good entry points on a bunch of different companies. I'm going to continue to dive into that and answer more questions around companies and the fundamentals and what they look like at bottoms and what they might look like at tops. We will also go over some of the metrics that I follow and look at for companies that are non-commodity companies and metrics that I look at for commodity-based companies. They are different. Commodity prices are an important factor on a lot of the financial metrics that you look at. At bottoms, they're going to look pretty crappy, and at tops, they look very good. So we'll talk about all that and my approach, and I'll give examples of what I would consider to be an ideal entry point, what it looks like. And then maybe you can replicate all of that stuff for yourself, define entry points for yourself. But there are a lot of things that I deem highly important when I look at things, and I'll break that all down as best as I can. And we can continue to go over it if you guys still need more practice at it. But that's what I've got for today, guys, and we'll catch you next time. This is Finding Value.